Some of the most common questions I get, and this happens every 2 years, every 4 years, whenever there is an election, especially like the big ones we've had the last few years, is what changes are we going to make? How are we going to invest? When so and so's in, does the market do better? Or when the other team is in, does the market do better? What does all of that look like? And of course, everybody thinks when their team is in office, the market does better. But we're just going to talk strictly about numbers and data. Don't throw tomatoes at me through your computer screen. This is obviously some treacherous territory. So I'm just going to keep this strictly focused on the numbers and what we've seen historically. The numbers don't lie, the charts don't lie. And I think of a story that came out last week. Actually, if you follow college football, you know that Kirk Herbstreit always brought his dog Ben with him everywhere he went. And Ben was an awesome dog and he had a ton of friends and he didn't care who you voted for, what you looked like. Ben brought happiness to everybody. And so I like to think about that. I like to think about Ben in these situations when a lot of people are really happy and a lot of people are really upset after an election. Let's all try to be more like Ben. If you didn't see it, there's a great little video out there on social media of Ben the dog. My wife and I lost a dog about a year and a half ago. His paw prints in the clay and in the display case behind me here. And so we definitely got choked up and teary-eyed when we watched that story about Ben. So think about Ben. We're going to be in Ben mode while we go through this. All right, here's me, Andrew Hoffmeyer, CEO and Senior Wealth Advisor, certified financial planner and certified estate planner. I own the business Hoffmeyer Wealth Management with my wife, Kelsey. She is the VP of Client Experience. She makes sure everybody is happy. We've owned this business for a long time and love working with our clients and walking through and answering some of these questions that they have, especially during contentious election seasons. So let's dive in. I've got a few slides I want to walk through. And the overall theme that you're going to hear me say, I'm going to repeat myself a ton of times, is stay invested. In general, as we see on this first chart here, it doesn't matter if the chart is blue or if the chart is red, overall markets go up. This dates back to, I think, 1950s, and it shows that basically every president who's been in office during their term, we had a positive return in the S&P 500. So, people always like to think, well, when so-and-so's in, I'm not going to be invested in the market because it's going to be horrible returns and the market's going to go down. Well, if we look at the slide, we can see that that's not necessarily the case. Another thing that I'll point out here is we see this general upward trend, but if you look at right around year 2000 in the chart, we have to think about what else was going on. And then prior to 2010, I think that's a great 2 decades of really analyzing what was going on. So if we look leading up to 2000, we had this massive increase in market return. That was the Clinton era. That's the best one on the screen. That's a plus 209%. But can we give Clinton all the credit there? Maybe we can, maybe we can't. But we have to think what else was going on there. If we remember that time, that was the tech crash, the tech boom, I should say, because it hadn't crashed yet. It was the tech boom. And during that time, we were paying so much money for companies that had never earned a dollar of revenue, and that eventually had to come to a head. And the result, obviously, is what we experienced in 2000, 2001, 2002 during the tech crash. And then we fast forward there, we've got the Bush campaign there, the Bush presidency, minus 36%. Well, there's a lot that was going on there. First of all, he inherited this tech bubble, which eventually crashed. And then we had 9/11 in there, and then we had a global financial crisis in 2008. And I think all of that's really important because I've always told people what I think matters more than who's in office is what the Fed is doing and what interest rates look like. So I don't like to get too caught up in who's in office, who won the election, how are we going to go to cash, what are we going to do? Let's focus on what the Fed is doing when we're making those decisions. But all in all, markets go up over time, as we can see here in the chart. So don't make any rash, emotional decisions, especially post-election. And I will say real quickly, these slides are all courtesy of YCharts, who we have a new relationship with, and they put together these awesome, beautiful slides. So thank you, YCharts, for giving us these slides. Okay, so the next 3 slides here are some of the most common questions I get from folks. Three, I would say, simplistic questions without looking at the big picture. So the first one right up top here, wasn't a question. Question came prior to this, and this was a follow-up comment. The question was, should I not be invested this year, 2024? Should I pull out of the market? This was a friend of mine who asked me this, and he kind of followed up with that, and he said, well, my dad knows a lot of financial guys who are in the know. I was like, what does that mean? And apparently all these guys who are in the know said that election years are bad years and you should not be invested during election years. So what happens if you are not invested during an election year? Well, my purple chart down there, this again goes back to about the 1950s. If you invested, I don't see it on my screen here, but I believe this is a $10,000 initial investment back in the 1950s. If you did not invest during election years dating back to 1950, your 10,000 would grow to about $1 million, which is pretty cool. I think we would take $1 million off a $10,000 investment. But if you stayed invested all 4 years and didn't pull out during election years, your $10,000 is more like $3 million. So do we want to avoid being invested in presidential election years? Probably not. Next question I get here is, I'm only going to invest in when Republicans are in office. I'm only going to invest when Democrats are in office. Well, okay, let's apply that metric. Let's see what happens if someone comes to me and said, well, should we pull out because so-and-so won? Here is the result of that. That same $10,000 invested back in 1950 would be worth about $77,000 if you only invested when Republicans were in, and about $400,000 if you only invested when Democrats are in. Now, again, don't throw stones at me here. I'm just the messenger. There's a lot more that's going on behind the scenes. Tech crashes, 9/11, global financial meltdowns. If you pull some of those metrics out, these numbers obviously change, but what is more important than the red and the blue at the bottom is the fact that our gray line, which is being invested no matter who's in office, is a ton more money from our initial $10,000 investment. So again, the theme I mentioned in the beginning, we're going to stay invested. Okay, the third thing that I hear is, and I get this one a lot, it's either, should I just stay invested and then after the election pull everything out, or should I pull everything out and then after the election put my money to work? And it's funny when I get these questions because people, they don't ask them like, is this a true statement? They ask them as if to, here's the way they ask them. They say, well, since the market is going to go up until the election and then everything's going to go to crap after the election, what should I do? And my response to that is, can I have your crystal ball? Because my crystal ball didn't tell me that. So that is cool that you know that. We can make a lot of money since you know what's going to happen going forwards. Okay, so being invested up to the election or vice versa, here's what that looks like. In this chart, these charts were created pre-2024 election, so a little bit of an update here. I'm not going to go over all these numbers, but let's, in our left column is the day after the election. And the right column is 2 months after, so basically November to January, Inauguration Day. Day after the election, let's go down to the second column row, 2.2%. The most positive market reaction that we ever had the day after was in 2020 after the Biden win. But, okay, 2 points on that. We actually didn't know who won at that point. It took a day or two. So that 2.2% to me is kind of irrelevant because we didn't have a winner. And that is now updated as of 2024. The most positive market reaction that we've had was the day after the 2024 election with the Trump victory. Okay, the most negative was right below that, the next row, -5%. This was after the Obama victory. And we have to put that into context as well. Did it drop 5% because Obama won, or did it drop 5% because we were in the middle of a global financial crisis? Things to think about. The numbers are the numbers, but they don't always give us the whole story. Those next two rows, those are kind of dated numbers now. And what I think is the most important on this chart is the right column. And that tells us that Basically, markets go up between election day and inauguration day. So, to answer the question, should we be invested until the election and then pull out after because everything is going to tank? According to this data, I would say the answer to that is no. So what does it actually look like leading up to an election or in an election year? This chart here, this is the VIX index. It's volatility index. So think of it this way. When this chart is up, markets are down. When this chart is down, markets are up. As we can see, volatility ticks upwards pretty significantly on average until election day. When this chart's up again, that means the market goes down. So the market is going down typically leading up to election day. After that, the dust settles, we know who won, and then volatility goes down. Now, I know on the previous slide, I just said that we don't want to refrain from being invested leading up to the election and then invest after. And this chart sort of contradicts what I said. But let's think about the fact that this chart shows volatility spiking from September to November. So what if you did that move and you stayed in cash from September to November? Maybe that would work. But history shows us that if we miss crucial up days in the market, that has a significant negative impact on our overall performance. So why try to time it? You have to be right on the way out and right on the way in. So when I look at this, I say just expect volatility before an election. That doesn't mean you're going to pull out of the market. You're just going to have experience some volatility. All right, presidential election years, real quick on this slide. This just shows that during election years, like we're in 2024, as I'm recording this, the market typically goes up. We only have, let's see, 1, 2, 3 negative years there. And one of those, some of those were kind of right off the Great Recession, and the other was the global financial crisis of 2008. So on average, during an election year, the market goes up 11.5%. This dates back to 1928. And we're up about 27% this year, 2024. Been a good year. Here's a good one, and I think maybe there are some investment companies who will kind of play their strategies in tandem with this data here. 1, 2, 3, 4. What's the best year and the worst year of an election cycle? And this data does tend to sort of repeat itself. All things equal, I should add. The best year typically is the third year there after the midterms, average gain of 17.6%. Second best year would be the fourth year, so the election year itself. And then the first year would be the third best. Second year is kind of the year where I guess for whatever reason the market doesn't like the second year of a presidency, but all 4 of those are positives. So we're going to stay invested all 4 years. This chart just shows opportunities based on party, and I'm not going to talk about what opportunities there are. We have a great investment team, a great research team that sort of does this research and puts together this information for us, and then puts those plays into our portfolios. And I think they do a great job. But what I circled here was just something that I found interesting. 2005. I have energy circled, and this again goes to what's going on in the world. Was energy up in 2005 because Bush was in office? No, what happened? Major event happened down in the New Orleans area, Hurricane Katrina, natural disaster. So the price of gas skyrocketed, the price of oil skyrocketed. And then I also highlighted energy in 2017 and 2021 because kind of the common theme here would be Trump victory, big oil, that's going to do well. And then vice versa, 2021, Biden campaign, green energy is going to do great. Let's get out of oil. Complete opposite of that. Energy was down 1% during Trump's campaign or in 2017. And it was up 50% in 2021. And in fact, if you look at the performance of the green energy funds and ETFs during all of Biden's presidency, they're actually down significantly. They got crushed. So it's a complete opposite. So that's why it's important to have a research team who's working on this behind the scenes. That way you don't just make decisions on a hunch, or because that typically is not going to work out in your favor. So, okay, last slide before some disclosures. What's the best combination? Dating back to 1950, here's what we've seen. The best market performance has been a mixed, a split Congress, House and Senate, with a Democratic president. Democratic president with a mix in the House and the Senate. The second best is right next to that, their Democratic president with a Republican, fully Republican Congress. And then if we look at the third best, that's going to be Republican president with a mixed Congress. So a lot of times the market likes to see a split gridlock. That way things can't just pass at will. This is interesting. I don't know the number on this, but this came up in a call this morning. 1950 to 2023 Republican president, and this is important because it's what we have right now, the red wave. Republican president with a fully Republican Congress, and I guess House has not been decided yet as of the recording of this, but likely going to be a red wave. That average performance is 11.7%. But if we take out some things like basically the Bush presidency, the tech crash, as well as the global financial crisis, that number is obviously significantly higher. So that's what we have right now. So we'll see what it gives us the next 4 years. And overall, again, the theme of this is just to remain invested. I'm going to pull up some disclosures here. Obviously, investing involves risk, and this data was again taken from a presentation that YCharts put together. And again, we thank them for that. So there you go. There you have it. Reach out to us with questions. Hope you enjoyed it, and continue checking our social media pages for more information. Take care.